All right, so let's begin the show with our segment called as Meet the Fund Manager. And today we'll be talking about Flexi-cap category. And in that category, we'll be having a discussion with Trideep Bhattacharya, President and CIO Equities, Edelweiss Mutual Fund. Trideep, good evening and welcome to the show. And Edelweiss Flexi-cap Fund is the fund in focus, where we'll be talking about your strategy and your exposure in the fund portfolio. But before that, let's talk about the markets. Again, a new week and a new high. And ever since the rate cut, we've seen the market following the global trend. But along with that, I also want to understand the trajectory that RBI would want to take as far as rate cuts are concerned. And well, you talk about the market momentum later on. But yeah, let's understand the RBI's understanding towards rate cut going ahead now.
Good evening, and thanks for having me on your show. I think the first thing that I would highlight is a change in the interest rate regime. From having seen rising interest rates for the last 2 or 3 years, we globally, I'm talking about. Here we took the first step in September towards a falling interest rate regime globally. What that implies had sectoral implications, portfolio implications, but more importantly, a rate cut from a global leading central bank opens the floodgates or opens the door for emerging market central banks to start thinking about cutting interest rates. And that's where we are. What you saw in the form of, or what you're seeing in the form of markets are a reaction to the same. What is also interesting is the US central bank, in the way it changed its economic forecast. It talked about a mild change in economic forecast rather than a big one. What that means is, effectively, they expect a soft patch in the United States rather than a big recession, which was basically a worry going into the interest rate cuts. So all in all, positive for the markets, particularly for emerging markets. Now, in India, we haven't seen the specter of inflation to the extent that we have seen in the United States. But nevertheless, keeping currencies and other variables in mind, I'm sure RBI governor would have that in mind when they think about rate cuts over the next 3 to 6 months.
All right. Let's talk about your Flexi-cap fund, and based on that, the kind of strategies you might want to advise our investors also. But before we get into the nitty-gritties of your fund, let's also understand the kind of valuation across market caps that you are seeing in the market right now. Do you think large caps are much more comfortable than mid cap and small cap, and maybe an investor who might want to rebalance their portfolio can slightly go heavy on large caps, looking at the comfortable valuation, and also because the rate cut scenario that's emerging, will be seeing a lot of benefit towards this particular market cap?
Interesting question. So I would sum up the valuation situation something like this, that if you divide the market into two parts, one is large caps and the second is mid and small caps, what you will find is the valuations of large caps are in line with the 10-year average. So there is no valuation fraud or excess sitting amongst large caps. However, as you move towards mid and small caps, what we find is that the valuations on average are about 20 to 45% more expensive than the 10-year average. But that's only one half of the story. The other half of the story is, of course, that the earnings growth of mid and small caps are almost double in many pockets as compared to that of large caps. So when we're looking at investing in markets in totality, then large cap valuations are in favor, mid and small caps earnings growth are in favor. But in mid and small caps, one has to be a little more selective while stock picking, because clearly there are excesses in some pockets. So keeping that in mind, I think Flexi-cap as a mutual fund category is probably in one of the sweet spots of the market, because it balances the valuation comfort on one side of large caps and at the same time calibrates the earnings growth of mid and small caps in a much more calibrated manner overall. So that's why I think that Flexi-cap as a category is a very good option for investors to think about, particularly the conservative investors in the current market scenario.
Sure. Talking about your fund portfolio, Edelweiss Flexi-cap fund portfolio, what's the current exposure like across market caps?
Sure. So, I mean, if you look at ours specifically, we are large cap, broadly speaking, is about 70% of the portfolio, and 30% of the portfolio is comprises of mid and small cap. What that means is that we have adequately taken care of the valuation side of the equation by through our exposure in large caps, and also stay selective while picking stocks within mid and small caps adequately, so that whenever the valuations are on the higher side, we make sure that we get earnings growth commensurate or better than the valuation asked. So hence we feel a 70-30 mix is just what the doctor ordered for the current market conditions.
Trideep, what sectors are you looking at as far as large caps are concerned? We'll also talk about select mid cap where you think there is still scope or headroom available. But then in your fund, as far as large cap exposure is concerned, what are your top 5 sectors?
Yeah. So I would sort of sum up like this, that ultimately, if you put in together the fact that we have entered into an interest rate cut regime, the sectors that benefit from the rate cuts over the next 6, 12, 18 months are a few of the areas that we are overweight on, which include non-banking financial companies. We call them NBFCs. We are also positive on real estate. We think we are in the middle of a 5 to 7 year upcycle in real estate. And thirdly, IT services or information technology in the broad sense, where we think that earnings are bouncing around the bottom. And as interest rates globally, lower interest rates globally take hold and economic growth improves over the next 12, 18 months, you will see a gradual improvement in growth rates coming through. So these are the 3 areas which we think are potential areas for potential beneficiaries of rate cuts and right suited for current markets. Apart from this, we also like the capex cycle related stocks and power. Companies exposed to power as a supply chain, because both of these areas, in my opinion, are the focus of the current government in terms of future investments over the next 3 to 5 years, and earnings for these 2 companies are likely to be better than market average. So those broadly the areas that I would say would comprise about 70 to 80% of the portfolio that we run in the form of Flexicap fund. And the final area that I would top that up is companies in the consumption sector, particularly the ones that are exposed to the rural economy, are currently seeing a bit better days in the sun, given that the base has been pretty poor over the last 2 or 3 years. And courtesy monsoon and better sowing, we expect better days ahead. So that broadly sums up our portfolio positioning, keeping in mind the current terms and also keeping in mind where we think earnings are likely to be resilient over the next 2 to 3 years.
All right, Trideep. So we're looking at financial services, IT, auto, capital goods, oil and gas. Let's focus on financial services slightly, because 26% of your exposure goes out there, and the top holdings, we have HDFC and ICICI Bank on the first 5. So talking about banking, are you more bullish on private banking?
Basically, if you subdivide the financial space into 3 or 4 parts, one is basically non-banking financial companies, NBFCs, private sector banks, public sector banks, and insurance and capital markets. Within all of this spectrum, which we have now to invest within financial services, we are particularly positive on NBFCs, insurance, capital markets, and then private banks. We have been overweight on PSU banks for a good while, but we have taken profits and moved on to more to banking, more to private banks in that context. But if you look at our key overweight, they would probably be within financials, NBFCs, and capital markets.
Pradeep, let's focus slightly on the mid-cap category, and because you also look after the mid-cap fund for your fund house. You mentioned being selective as far as mid-caps are concerned. What specific sectors are we talking about, and what kind of valuations are comfortable then?
Yeah. So I think in mid-caps, the framework that we use is to make sure, as I said earlier, that earnings growth is concomitant with the valuations that we pay. And hence, we have to deep dive and do specific analysis on subsectors within which we find this equation to sort of hold true overall. So we find such a situation hold true in select consumer-focused consumer durables and rural-exposed consumer names. We also find companies exposed within power theme, particularly on the mid-cap space, which are doing relatively better position, and IT services, where the mid-caps have better growth profile than other segments. This, of course, is just a subsegment of various other stocks that we like. Our mid-cap strategy is a lot more bottom-up, company-focused rather than just sectors. But those would be 3 or 4 areas where we are still finding value as compared to many others. The final area that I would point to is select PSUs within defense. Now, this is one area, defense, where we clearly see that the earnings outlook is robust, but some of the private sector companies are quoting at very high valuations. So this is one spot where we have been more selective and focused on select PSUs who have developed meaningful expertise in this area and have been operating for more than for half a century in this area, and we find still the valuation equation in favor of them.
Trideep, now talking about having more exposure or the portfolio exposure towards large cap, why would one want to consider a flexi cap instead of a passive large cap? It's all about giving stability to your portfolio, and at the same time, looking or expecting a run up in the large caps. Why can't one go for a passive large cap, or you think one can definitely go for a passive large cap, but then to have a certain kind of a select mid cap and small cap, which also gives you a good risk reward ratio, one might want to consider a flexi cap with a heavier or a large cap bias in it?
Yeah, so I think good question. So as opposed to a pure large cap fund, whether it is active or passive, the point that I would like to make here is that valuation anomalies given the flow equation gets corrected sooner than what most people anticipate. For instance, some of the very high profile, high valuation defense names or capital goods names, which were quoting very high valuations over the last month or two, have corrected more than 20 to 30%, even though the broader market has not corrected. Now, for an average investor to spot these changes and act accordingly and change from one fund to that of another is a very tedious exercise. Hence, in that context, if you have a fund, like let's say a Flexicap fund, which has a certain exposure to large caps, keeping in mind the safety, let's say 70% like we have in our case, and 30% in mid and small caps, if the value, as and when the valuation corrects, we can quickly make the change within the fund without incurring too much of transaction costs, but at the same time, kind of capturing the valuation changes that happen as a result of market move. This is only possible if in this under the single fund umbrella, a fund manager has the leeway to make that change. And that is the reason a flexi-cap fund where one can operate across market caps without any regulatory limits makes the cut, particularly in the current market scenario.
Trideep, talking about the cash component in your flexi-cap fund, what's the current status?
So our cash component structurally is actually on the lower side. We have about close to 3% cash. But what one has to keep in mind that as a specific fund house, we have taken the view that we will not hold cash. Cash, in our opinion, in terms of the timing the markets, particularly ins and around big moves, is extremely tough to do so. Hence, we feel that it is better, particularly in the context of the medium term, in the next 3 to 5 years, where we expect India to report resilient earnings growth. It is better to stay invested. In fact, it is better to balance the conservatism via shifting around market cap between large cap, mid and small cap, as opposed to keeping the money in cash. So we have played the conservatism via our large, mid and small mix, as opposed to holding larger cash or lesser cash at different points in time and cycle. But to answer the long question short, we have currently about close to 3% cash in our current level, in our Flexicap class.
One last question, Trideep, and then we shall wrap up the discussion. How many Flexicap can one have? and even if one wants to have more than one flexi cap, what's the kind of exposure in that particular fund one must look at? Because diversification is a very important aspect in your portfolio that you might want to consider. So how to make sure that even if you're having more than one flexi cap, the exposure, the portfolio exposure is not the same?
Yeah. So I think a difficult question to sum up, because you're asking me effectively to comment on competitors. But I would say that there are 2 or 3 parameters that people should keep in mind while choosing a fund, particularly a flexi-cap fund. I think the first thing is basically the risk appetite of the consumer. Here we are talking about relatively more conservative consumers who want to for sure play the equity markets, but at the same time want to have lower volatility as compared to kind of a mid or small cap category which would retain. That's the first thing, and in that case they should sit with their advisors to take a view where they stand and invest accordingly. Second, within the various flexi caps that are there, it is important to have a reasonable mix of fund if there are more than one, where the large, mid, and small mixes are quite different. And if one were to keep that in mind, then even if they have multiple ones, the overlaps would be relatively smaller, so to speak. So maybe one large cap oriented flexi cap could be complemented with another more mid or small cap oriented flexi cap fund, or maybe a multi cap fund as the advisor suggests. So those would be 2 or 3 things that I would highlight on a broad-based basis on your channel. I think the rest I leave it to the advisor to do the needful and advise the right fund for the right customer.
All right, Trideep, I think with that it's a wrap. Thank you so much for taking time out and explaining everything about the markets and your flexi-cap fund to our viewers today. Thank you so much.
My pleasure. Thank you.
If you like this video, then like, share and subscribe to ET Now.